Hi there, Happy New Year. This is the routine weekly traffic light update for the week ended on January 6, 2017 from Crystal Clear Indicator. Prior to going into the detail of the presentation, here are the disclaimer. Traffic light and capital appreciation point are the results of proprietary risk analysis model and should be used as a part of your due diligence process. Crystal Clear Indicator is not a licensed financial advisor. Investing involves risk. Here is the agenda. We will review the latest traffic lights on S&P 500, Dow Jones, and NASDAQ Composite, and we'll be looking for bearish and bullish trades. Here is traffic light S&P 500, a long-term indicator. The current light is yellow because we are the green line is right here. And the light has turned yellow from orange since September. Traffic light S&P 500 continue to descend to a lower risk level. When there's a pullback, it could be a good entry for long positions. I also like to review the legends with you. The horizontal purple line here applies to the traffic light S&P 500, the green line. The red line is a long-term conservative line. When the green line crosses the red line successfully, it is better to take a long-term conservative position as shown here in 2009. The purple line is a long-term position indicator. When the purple line is crossed by the green line and crossed back, it is less risky to take a large long position. The clip from November 18th, we compare the current situation to that of mid-2012. In the 2012 period, as the index attempted to make a new high, there were pullbacks, and each pullback is less severe than the one before to keep the breakout intact. Let's observe whether the current market shows similar traits, but with the caveat that the current PE is much higher than that of 2012. As a result of that, it is possible the ascending strength will not be as strong as that in 2012. Let's look at the traffic light Dow, an intermediate indicator. This indicator has a good history showing intermediate bullish and bearish signal, especially when the bullish line, red line, and the bearish line cross over and showing divergence. In the 2010 period, when the red line makes a new high, the green line stays low, the market ascends very strong. In 2011 period, as the index makes new high, the red line does not, and the green line starts growing up a little by little. Eventually, market has a more severe correction. At the macro level, in September 2016, we made a red line reach an intermediate max. Once you reach your max, you retreat to this level. I will draw the support level in the next slide to show you where we likely to go. The orange line shown here are the formal bounce points in the 2010 peak and 2013 peak. And the market really starts so-called another bullish trend after it bounce from this level. I will zoom in the graph in the next slide and discuss bullish and bearish observations. Here are some bearish and bullish views. On the bearish side, there are 2 points. First, the red line is descending at the resistance level. It is usually end of a short-term bullish run. Second, the bearish divergence could be forming. As the index tries to attempt to make a new high, the red line does not. It is not alarming now because the green line is not ascending. On the bullish side, the green line continues to descend. I would say cautiously intermediate bullish trade continues and the pullback are expected. We can see the similar things in traffic light NASDAQ. As you can see, the red line recently made a new high. At the current, the recent max is the highest recorded in 11 years. In April 10 period, 2010, the index retreat from this situation with significant pullback. In May 2013 period, there was a smaller pullback. I will zoom in the mentioned period in the next slide. In both situations, the index starts to descend when the red line starts to descend. The bounce starts after a cap on S&P 500 occur. In the 2010 period, there was 1 day 1, or 1 day 2, 1 day 18, 1 day 4. In the 2013 period, there's 1 day 4. If you desire to know more about the S&P 500 cap, you have the privilege to access the Starter A service for free during the trial period. The orange line here, draw here just to illustrate that. That's where the bounce starts, a support level for the red line. And I will show you that on a greater level in the next slide. Here's where the two orange line lies. And this is where we are right now. So it could take a while for us to get to this level. Here's the zoom-in graph of a NASDAQ traffic light. Here are some bullish and bearish observations. On the bullish side, the red line made a new high as the index made a new high. Second, there was a bullish crossover in November 14, 2016. On the bearish side, the first the red line started to descend and continues to descend on December 13th, and the green line started to descend a little. This piece of information was released on subscriber website on December 13th with the email notification. Second bearish, observation is that it is making a higher high relatively to September 7th, 2016. In summary, traffic light S&P 500 is in yellow and shows more long-term bullish sign. Traffic light Dow and NASDAQ shows a more intermediate bearish signs. Traffic light NASDAQ red line start to descend and expecting pullbacks. Consider to take some profit on long-term positions and increase the cash positions. With unsynchronized bullish and bearish trades, as shown in traffic light NASDAQ and Dow, the market tend to consolidate. In the last consolidations, similar consolidation, S&P 500 happened before the bounce starts. Thank you for listening.